There's been a lot of talk about BitBonds the past couple of weeks. Our friend Pierre Rochard, Bitcoin OG and legend, founded Satoshi Nakamoto Institute when he was in college.
CO2 expert, Pierre Rochard.
Also CO2 expert. Yeah, ratioed the New York Times with his little CO2 meter monitor. Yeah, absolute legend. He has started a company called Bitcoin Bond Company. I think it's just called the Bitcoin Bond Company. And yeah, so this is a thing. Let's just get into what it is, actually, the details here. Okay, so this is from VanEck, and VanEck is getting into this idea.
Brady, just to clarify, this is not Pierre's company. This is
not Pierre's company. VanEck published this, actually. No, I was just shouting out Pierre there as an example that this is this idea is growing amongst investors and entrepreneurs. Yeah, these are digital bonds. They're directly on the Bitcoin blockchain, and they combine traditional bond markets with Bitcoin's decentralization, transparency. It's programmable using DLCs, discrete log contracts, obviously global accessibility. It's all the benefits of the global 24/7 asset, the liquidity of Bitcoin, etc. This could be used by corporations. Corporates could issue these without the need for banks or middlemen. Retail investors could participate as well, and this is usually the domain of large institutions. So that's pretty interesting as well. So you can see the governments also, beyond just corporations, could be interested in this. And this is one of the main points here is people have been talking about the United States issuing BitBonds as a way to control debt and get exposure into Bitcoin as well. So how do they work? So the basic structure then, and this is again VanEck, and Justin Beckler wrote a great thread on this. So I'm going to shout him out and include his commentary here. But the U.S. issues a 10-year bond. So it'd be like 90% plus treasuries, or 90% treasuries plus 10% Bitcoin purchased at issuance. And then investors get full BTC upside until hitting a 4.5% annualized return. And after that, the gains are split 50-50 with the treasury. So that's one setup here. Pretty interesting stuff. Would love to hear, John, what you have to think first, and then we can go around.
Yeah, for sure. So let me start by saying I love this idea. I love that it's being talked about. I love that people are putting some intellectual brain power into this, outlining it, presentations. I've seen it from Brian Estes. I've seen it from Andrew Hones. I've seen it from VanEck is the one we just showed. So kudos to them for doing it. Okay, now that I said that, let me throw some cold water on it. Basically, while I love the idea, I just don't think this is happening anytime soon. And again, that doesn't mean don't talk about it. The conversation has to start somewhere. But
in particular with the government, or just at all?
With federal governments.
Okay,
and
great.
Yeah, that's a good clarifying point that I want to get to. It's just because if they do this, you're signaling to the world, hey, global investors, you guys didn't really want our debt when it was denominated purely in our currency at an interest rate that we can afford, right? There's always a rate that people want your debt, but if there's a natural buyer at some very high interest rate, that's a problem for all these indebted nations. And if they're basically saying, you guys didn't really want our debt under those circumstances, let's throw in a Bitcoin kicker and that'll make you want our debt. It gives the show away. It's like fiat is a confidence game to a certain extent. And I'm not saying this will never happen. I just think we're actually years away from it happening. Because what I think governments need to do for several years is going to be hold the asset and just get comfortable saying, hey, part of our assets that we hold as a country is Bitcoin. Years need to go by for that to happen before they start saying, hey, we're going to incorporate this into our debt issuance. And then just final point, I would say, I think local governments, state and local in the US, for example, have a way better chance of doing this because they're not the issuer of the currency. They can make it more attractive for an investor to come in and buy that municipal debt against state, city debt with a Bitcoin kicker. They don't have to worry about the image reputation management of the dollar. So that's my take on it. I'm happy to be proven wrong. If Besson starts issuing BitBonds in 9 months, I'll be happy about it, but that's not my forecast.
So I'm definitely with you that I don't think it happens anytime soon. And it's a road between here and there, though it does make sense on principle. The one way that I think it makes more sense is, let's say the US government buys $100 billion or $500 billion of Bitcoin. suddenly it's very attractive for them because they drive up the value of their own strategic reserve while doing it. And so it's really win-win for the government at that point if they're also benefiting from the Bitcoin growth. So there's a way you could do it that I think like paradoxically almost stabilizes the currency. I'm really shooting from the hip here and haven't thought about this, but let's say the US government owned $1 trillion in Bitcoin and they issue a BitBond. While in some ways they're signaling like some sort of weakness in the dollar, they're also like capitalizing their own balance sheet and their ability to stabilize the dollar at the same time. So I wonder if, I don't have an answer. I'm literally shooting from the hip here, but I wonder if there's something there. Second thought, I wonder if it makes sense for corporations to do. You know what I mean? I think there could be an interesting angle for corporate bond where most of it is dollar denominated, but there's a Bitcoin kicker. So I think it's stuff to think about. But I like the final boss is the sovereign currency issuer.
Yeah. How are these different from Saylor's bonds?
Saylor's bonds are basically equity. So they're convertible bonds. So you're basically just bet like your return is basically like 0 or a lot in some cases. Like it's a much more binary outcome where this would be like your return is 5% plus maybe more. Something like that. If I'm understanding it correctly. I haven't spent a whole lot of time on this.
Yeah, the after 4.5% in the example that I just read out was 4.5% return is guaranteed. You get all of the upside of the Bitcoin up to 4.5%, and then it's split 50-50. So you still do have the potential to gain more on top of the 4.5%.
And if Bitcoin's long-term performance has shown us anything, that's a very high potential.
Exactly.
I think the absolute worst case scenario is Bitcoin fails to perform. They only get the 1% or whatever that's coming straight off of the debt interest. But that's so unlikely if we're talking about a 10-year bond.
Yeah.
And it's also like in a world where the US government is issuing these at scale, say goodbye to big Bitcoin crashes. You know what I mean? Like it's a different world.
Yeah,
for sure. And there's one other point I forgot to make is that you might argue, what if the US kind of gets backed into a corner and they have to do this, or they're just like highly incentivized to do it? I would just point out that has happened many times. That's 2008, that's 2020, that's 2023. You know what the button is that they push when they're backed into a corner, when there's a financial crisis, market liquidity? Fed by Treasuries. That button is not broken yet. I don't think they're going to say, oh, we can't push this Fed by Treasuries button. We have to do BitBonds. So my view is just that we have years of, and I think what Steven said aligns with what I'm saying, is that if they start acquiring more and more Bitcoin, then BitBonds becomes more feasible. I think that's the order of operations.
Yeah,
exactly.
So on that topic, take a look at Justin's. He's been bearish on the SBR, the Strategic Bitcoin Reserve, really from the beginning. And he lays out a reasonable argument against it, as he usually does. So he says here, compared to the Strategic Bitcoin Reserve, which is politically stuck and reliant on congressional whims, this model uses market incentives. BitBonds harness investor self-interest instead of hoping politicians do the right thing. They won't.
Honestly, I think that's a fair take. I think that's a good angle, right? Like the BitBonds take market demand into account. The government acquires Bitcoin through the means of market demand rather than through legislation. I think that's my takeaway of that post. It's more nuanced than that, but respect the take.
Yeah. I like Justin, and so this is just a good-natured debate in a sense. Like he's been a friend, but I feel the opposite of it. I think just like executive purchases are more likely than BitBonds. I think BitBonds is more complicated in many ways. Whereas selling off 500 million of crypto in the crypto reserve to buy 500 million of Bitcoin in the Bitcoin reserve is easy. Whereas rerouting some of the tariff income is easy. Whereas selling off Fannie and Freddie is easy. Whereas like there's just all these ways to like do what is effectively budget neutral and get some amount. And so if I was betting on a betting market of what do I think happens first, some sort of incremental purchase via executive authority or BitBonds, I'm going with the purchase. I'd be pretty comfortable sizing up on that bet.
Yeah. And then if you want market incentives, like John was saying, that you can use BitBonds to pump your bags. So, yeah.
There's one other interesting thing to say about this, which is You guys remember how Bitcoiners have talking about investor mandates? And we talked about how the ETFs opened up a lot of pools of capital because there's a lot of investors out there, first ETFs, but then how Saylor, more so MicroStrategy, has provided access because entities can buy bonds. They couldn't buy an ETF. They can hold equities. That's fairly easy. And actually on this, Brady, you said, how is BitBonds different than MicroStrategy? BitBonds is even harder because BitBonds has the explicit Bitcoin kicker. So why am I saying all this? Because investor mandates are important. Every institutional investor in the world can own a treasury, no problem. Can they own a treasury plus in 10 years time, you might be getting some Bitcoin? Is that spot Bitcoin? Now they have to amend their investor policy statement. They have to figure out how to own spot Bitcoin. Maybe you work something out where you get ETF shares. But again, ETF shares is not a treasury. You're now telling this institution you have this like hybrid security where it's part treasury, part Bitcoin in 10 years. Those investor mandates don't change overnight. So even if BitBonds got implemented, my take would be that it would be more so like fast money hedge funds that would be in first. It's not going to be like mom and pop's pension plan that's rewriting their investor statement.
Yeah, I think that's interesting. Like how do you? They also could just cash it out. I almost think that would be what would happen is like you get paid out at the end of the note and it's like they sell the Bitcoin, which would also put price pressure on. It's something interesting to think about. Like I'm obviously I'm
like a sell wall. Yeah, no, that's interesting.
But I have to think that's the most likely thing, right? Are they really going to deal with like physical delivery? Maybe, right? In a world where like we're issuing fucking BitBonds, maybe people just take it. But they could also just liquidate it to dollars, but then it's net neutral outside of the sentiment part, which would be huge, would be very reflexive. I don't know. I'm just theorizing.
It's good. I'm glad the conversation's happening. There's definitely healthy debate here.
Totally. I think it's interesting.